So, you want a real powerful edge in your trading? The secret is learning to trade with the trend, not against it. Today, we're going to master continuation patterns. They're the key to knowing when a trend is just catching its breath before its next massive move. Let's dive right in. We've all been here, right? You're in a great trend, the price is just humming along, and then it just stalls. And that big question hits you like a ton of bricks. Is this the end? Is it all about to reverse? Or is the market just reloading for another big push? This moment, right here, is where so much money is made and lost. And that's exactly what we're here to do today. We're going to clear all that up. By the time we're done here, you'll have a solid framework for reading these pauses, so you can finally tell the difference between a temporary pit stop and a complete U-turn. So first, let's really get a handle on what this pause actually is. I like to think of a strong trend like a race car, just flying down the track. It can't go forever, right? Eventually, it has to pull in for a pit stop, refuel, and get ready for the next lap. That's a perfect analogy for what's happening during market consolidation. And this really gets to the heart of it. A continuation pattern isn't a sign of weakness or indecision. Oh no, it's a sign of confirmation. It's this quiet, low volatility moment where the market is basically recharging its batteries, absorbing any selling pressure, and just getting ready to keep going in the same direction. It's actually a signal of hidden strength. So, what's really going on behind the scenes during this pause? Well, a few things. First, you've got some short-term traders taking a little profit off the table, but the big players in the trends just soak it all up. At the same time, those big institutions are using the quiet period to build up their positions without moving the price. But most importantly, this pause proves that the other side, the bears in an uptrend for instance, they just don't have the muscle to turn this thing around. The trend is simply taking a well-deserved rest. Okay, this brings us to what is maybe the most critical distinction a trader needs to make. Are we looking at a pause or are we looking at a reversal? Getting this one wrong is probably one of the most common and most expensive mistakes you can make. This little table lays it all out beautifully. See, a continuation pattern confirms the trend you're already in. It happens smack in the middle of it. And because you're trading with the flow, with the current, you have a much higher probability of being right. A reversal pattern, on the other hand, it's signaling a total change. It happens at the very top or the very bottom, and trading it means you're fighting the current. The bottom line is this: focusing on continuation patterns puts the odds squarely in your favor. It's just smart trading. All right, enough theory. Let's get to the good stuff. We're going to bridge that gap between the textbook and the real world and see what these patterns actually look like on a chart. This is where it all comes to life. Let's start with a real heavyweight. This is the Rising 3 methods. It's a powerful 5-candle pattern, and it signals a super strong bullish continuation. And hey, don't just take my word for it. The source material flat out calls this the most reliable, strong, bullish candlestick pattern. So when you see this thing take shape, you should pay very close attention. It's a huge signal that the bulls are absolutely in charge. So let's do a little anatomy lesson. It starts with a big, strong, bullish candle that screams, "This is the direction." Then you get 3 little weak pullback candles. Now, the key here is that they have to stay inside the range of that first big candle. And here's a pro tip for you. The smaller and weaker those little pullback candles look, the stronger the breakout is likely to be. It shows sellers has zero conviction. And finally, you get the 5th candle, another powerful bullish one that closes above the high of that very first candle. Boom, the trend is back on, and it means business. Okay, next up is a much quicker one. It's a 2-candle pattern called separating lines. Now, if the Rising 3 is like a nice, controlled pause, this one is like an immediate, violent rejection of any move in the other direction. Let's look at how this works. Say you're in an uptrend and a bearish candle pops up suggesting a little dip, but then the very next candle opens at the exact same price as the day before and then just rallies like crazy. What does that tell you? It tells you that any little attempt by the sellers was completely wiped out the second the market opened. It's a super decisive, high conviction signal that the main trend is back on right now. This is why it's a favorite for traders looking for aggressive entry points. All right, so spotting these patterns is half the battle, but how do you actually trade them without getting burned? It's time to open up the trader's playbook and set some very clear rules of engagement, because in this game, discipline is absolutely everything. To do this right, and to make sure we're avoiding all those nasty false signals,
we're going to boil it down to 3 simple, non-negotiable rules for execution.
Rule number 1, patience is key. You only get in after the confirmation candle has closed outside the pattern. No jumping the gun, no getting excited. Wait for the close. Rule number 2, manage your risk. Your stop loss needs to be tucked in nice and tight, right inside that consolidation structure. This keeps your risk tiny and sets you up for a great payday. Which brings us to rule number 3, the profit. You should always be aiming for a reward that's at least double your risk. A 1-to-2 risk-reward ratio is our absolute minimum. Now, let's talk about the ultimate confirmation tool, volume. If you see a breakout happen on low, or even worse, decreasing volume, that is a massive red flag. That's a weak signal, and it's probably a trap. What you need to see is a huge surge in volume on that breakout candle. That's your strong signal. That's the market telling you that the big money, the institutions, are all piling in behind this move. So to put it all together, think of it like this. You have 3 pillars of validation for every single trade. First, moving averages. The pattern has to respect the major moving average, confirming you're on the right side of the bigger trend. Second, momentum indicators, like the RSI. You want to see them showing that the market is just resting, not building up steam for a reversal. And third, our favorite validator, volume. It should be low and quiet during the pause and then explode on the breakout. Check all 3 boxes and you've got a high probability trade. And that really brings us to the final takeaway here. You see, recognizing the pattern, that's just part of the job. The real secret is trading smarter, which means focusing only on these high probability setups and then executing your plan with ironclad discipline. I absolutely love this quote from the source material because it just nails it. Discipline separates profitable traders from those who suffer repeated losses from false breakouts. It's not about being the smartest person in the room. It's about having the patience and the discipline to follow your rules every single time without fail. So, I'll leave you with this one question to think about. You now have the knowledge to spot the pause. You can tell the difference between a real opportunity and a trap. The only question left is, do you have the patience and the discipline to wait for that perfect setup and trade it correctly? Because that is what will make all the difference in the world. Master that, and you are well on your way.